Hey everyone, it's Tip Tuesday. It's also Valentine's Day. So I'd like to wish everyone a happy Valentine's Day, especially to my wife Mary and to my two daughters, Adeline and Brielle. Today's tip is going to be centered around the federal funds rate and also inflation. And hearing a lot about those two things in the past year. So I thought I'd just highlight kind of what's taken place and what the Fed's doing. So if you think back to COVID times, production and manufacturing was slowed to a halt, right? So there weren't very many goods being produced for our economy to consume. Yet the federal government was sending us consumers stimulus payments. So the consumer remained surprisingly fairly strong during this time. So then what you have is you have a bunch of money chasing not very many goods, right? There maybe is 10 people fighting over the car in the parking lot instead of only 2 or 3. So that drives up the price of that car. So how does the Fed combat this? Okay, one thing they can use is monetary policy. Okay, they can raise the federal fund rate to slow how fast money is moving through the economy. Well, how does that work? The Federal Fund Committee meets 8 times a year. It's currently chaired by Jerome Powell. You may have heard of past presidents, Ben Bernanke, Janet Yellen. So what happens is as they raise rates, that also raises our borrowing costs. That's how we get directly affected as a consumer. So if you think of home loans, car loans, credit cards, lines of credit at the bank, it costs you more to borrow money. So if I was looking at a house that was $500,000, maybe when mortgage rates were only 3%, now when they are raised to 6%, well, now maybe I can only afford a $300,000 home. So as you can see, that slows down how many homes are selling, cars selling, etc. It just slows down the speed of money moving through the economy. It also can affect savers actually in a positive way, right? So if the Fed raises rates, now your savings account at banks will pay more, CDs should get a better interest rate, money markets, fixed annuities, different items that you have for your emergency money or lazy money out there, you can actually get it working a little bit harder for you. That's kind of what the Fed has done, is they've raised rates to try to slow the consumer down and control these prices. What they're hoping not to do is they hope not to push us into a recession, which is something that's very possible if they raise rates too high. So it's a delicate dance as they do this. So I'm glad it's their job and not mine. But at any rate, I hope this helped you understand it a little bit better. And I hope you all have a happy Valentine's Day. Thanks.